It is October 22nd. Michael Vaughn with Brian Acker. Great discussion last month about value versus growth, and I want to come back to that soon. Mm-hmm. But you have two items of unreported news which bear heavily on these markets. Absolutely. Let's talk first of all of what you're seeing at the U.S. Fed.
The U.S. Federal Reserve, quite interesting, has restarted quantitative easing.
I haven't seen that in the headlines.
But they don't want to call it quantitative easing. So what's been happening is large pools of capital, call it the Eurodollar market, call it what we call pejoratively the repo market, yeah. They're failing. So what people don't understand about these markets, and I don't want to get too down into the weeds on this, but these are worldwide funding mechanisms. And as I've been saying for years here on these things, all the European banks, all the Scottish banks, they're all bankrupt. Japan, all their banks are bankrupt. So what you're getting actually is a funding difficulty, certainly for these banks, and other banks willing to lend them any money because everyone realizes these banks are bankrupt. So the Europeans, they don't want to clean up that mess. Certainly the UK people are more focused on Brexit than their banking system, but we do see this breaking down. The Fed is trying to remedy this by continuing to dump excess reserves into the US banking system. That's why the US banks are getting a little bid here. They're getting jiggy, but no one really knows how to fix this thing because of its ephemeral nature. It's been set up just in terms of piecemeal patchwork, and now it's $1 trillion problem that we all have to focus on.
But in the shorter term, the additional liquidity raises the market.
Yeah, and I've suggested, certainly to a lot of clients here, that really the market doesn't really trade on fundamentals anymore. It trades on bouts of liquidity. So, and again, we're only about less than 1%, maybe 30 S&P points away from hitting an all-time high in the U.S. market. Well, again, we got another bout of liquidity coming. Don't be surprised we take out those new highs. Yeah. But again, once they start draining liquidity, you'll see the markets probably fall back again.
Well, all the recession signals are flashing, but we're bouncing around near the highs.
In the U.S.
Now tell me about China, which is your other unreported story, because I think it's connected.
Absolutely. So Michael and I went to China a few years ago, and I'm glad we did, because that window, I think, for foreign visitors is closing. So China, we've never lived in a world in the last 20, call it even 30 years, that China hasn't grown at least by 10% a year, just in terms of natural resources, in terms of they sucked everything in. And if China were to, certainly it's slowing down, or if it starts contracting, that is a major issue for the world. So
the signal of it is the renminbi.
Again, Michael and I were over in Japan. All transactions that we did, we did around 7 to the dollar, to the U.S. dollar, and it was surprising to me that merchants, even street merchants, they knew the 7. So even though the yuan was actually trading stronger, down to it got to about 6.5 to the U.S. dollar. But here we are now over 7. And from a psychological point of view, I can tell you, we are on the streets. Anything higher than 7, I mean, I think that's an indicator to the people, like things aren't really that good.
Well, the Chinese have been protecting that because they want to be a reserve currency, and if it starts to blow through 7.
Yeah, but also too, what's happening here is they're, in one hand, reducing interest rates, but on the other, because their capital account is not freely traded, in other words, it's stuck in, I have leftover renminbi, I can't use it anywhere else other than China. So again, what's happening here is money wants to leave China because everyone's seeing this thing. And so what's happening is we've got a slowdown in China matched by monetary tightness. Yes, they may be reducing interest rates, but money is leaving the system. And if that gets critical, obviously that is really bad news for China, and I would humbly suggest Australia and China, Canada, who's really benefited from China, certainly over the last 20 years, let's say, looking for potentially hard times. But again,
How does that affect your investment decision making today? I mean, it's a difficult question, looking for a short answer.
The central bankers, including the Chinese central bank, have been very good at keeping this thing alive. But the problems are getting larger and larger. So fundamentals, obviously, everyone's kind of checked out on fundamentals. Now the market trades on bouts of liquidity, but as we see, liquidity may be a mile wide, but it's only an inch deep. So if there's any fears out there, or if there's any action, for instance, China maybe doing something horrible in Hong Kong or whatever, this thing could go. But yeah, I gotta say, I could make an equally compelling case for certainly U.S. stocks to go substantially higher.
Yeah.
So this is not a thing where, sell, get out, there's too much risk here. It's actually, you've got to have, I think, in a well-diversified portfolio, you've got to have at least a lot of U.S. stocks there, because if this thing, all these issues that we're currently band-aiding, putting band-aids on, they could come home to roost, but it could really positively affect U.S. dollar equities. So I'm just saying, but sitting here every day, history's being made. We've never seen this before. We've never been in this situation before. So policymakers and everyone's are making up on the fly, and you're only here trying to read tea leaves. So
I love these discussions. I learned from everyone, and I'll be in for another one next month. Brian, thank you for your time.
thank you, Michael.